If you're watching this video, you should have already watched the clip from It's a Wonderful Life of it labeled George Bailey Explains Fractional Banking. I uploaded that under the video portion of the content section. Those are the videos that are not me lecturing, but are clips of other things that we've seen in class. That's the me showing a video in class and then talking about it kind of thing. So go watch that video first if you haven't already, because I will be referring to it. And optional, you can watch the lost ending as well. And then come back here, and then you might understand a little better what I'm talking about when I talk about it. So pause this, go to D2L, Content tab, go to Videos, and scroll to the bottom where you'll see a video entitled George Bailey Explains Fractional Banking or something like that. Fractional Banking and George Bailey are in the title. So, this clip from one of my favorite movies during the Christmas season, because I'm a big bag of sappiness. I remember as a kid watching it, my dad, who's worked for banks and has his bachelor's in economics, talked about what a great job the scene does at explaining how banking actually works. And as a young punk kid, I thought, yeah, whatever, Dad, you're a lame wad. And now I've grown up to be way lamer than he ever was. So I have to say, I agree that that is exactly how banks work. I mean, obviously it gets a little more complicated than that, but it is a great scene for explaining the banking system. And the fact that you don't just pop your money in a bank and then it just sits there forever and then you get it back. It's a little more involved than that. It's the answer to the question that I always had when I was young, that one of my kids asked me not too long ago, that a lot of people have. How do banks make money? You give them money and then they give it back to you whenever you want it and they pay you interest? That doesn't seem to be a very good business model. And if that's all they did, then it's not a good business model. So that scene does a great job at really sort of introducing how everything, how it's all possible. Also, it's also seen that introduces us to the Great Depression. Well, we introduced ourselves to that at the beginning of the semester, but that was the setting. There were a lot of bank runs during the Great Depression, which we'll talk about in more detail, the bank runs and all of that. It's starting to become more relevant now, though, as we're talking about banks. The problem with bank runs is, since banks don't have your money lying around, if everybody goes and tries to withdraw it all, the bank is in trouble. So this is going to be very relevant to this next topic that we're talking about with the financial system. And that was one way of handling a bank run without causing any trouble. Unfortunately, if anybody actually managed to do that in real life back during the Great Depression, they were the exception to the rule. The rule was banks collapsed and closed down, and a lot of people lost their money because they couldn't get it out of the bank in time. There was no insurance for it. The bank didn't exist anymore, and that just added to the big mess that was the Great Depression. So you combine that with a lot of the messaging we tend to get about banks and Wall Street and the financial system in general, and a big question comes to mind, and that's the title of this first slide. Why do we even need a financial system? It's just for a bunch of greedy people to get richer, isn't it? Well, yeah, a bunch of greedy people are in the financial system and they do get richer from it. That is true. And there's illegality and there's unethical behavior, and I'm not arguing against any of that. However, you'd be hard-pressed to find any economist who thinks we'd be all right without a healthy, functioning financial system. Third world countries versus first world countries. We talked about some of the differences. One of the differences we didn't talk about was the health and quality and scope of the financial systems, but that's one more thing that really does emerge when comparing countries that succeed economically to those that don't succeed economically. The financial system has often been called the heart of any major successful economy. If we don't have a healthy functioning financial system, we're in big trouble. And in the videos the video that I put up at the very beginning of this online portion of things, I mentioned that the difference between the Great Depression and the years following 2008 and every other recession we've seen is that we bounce back from recessions really quickly. And the reason I have a little optimism about how we're going to bounce back from this one is because it's like other recessions. It's not a financial crisis. The financial system is healthy. Great Depression in 2008, the financial system was not healthy. It was on life support, so it took a long time to come back from things. So that's kind of the overview of why we need a financial system, but it still doesn't really answer the question of why we need a financial system. Well, in other words, why is it that it works this way? How does it function? What does it do that's so darned important? Well, what it does is it brings lenders together with it turns savers into lenders so that savers and borrowers can come together in a market and mutually beneficial transactions can happen. We've talked briefly so far, not in too much depth. We went into it in a little more depth in micro, but a lot of you didn't take micro. Money markets can be represented on a standard supply and demand graph. Like any other supply-demand graph we've looked at, price on the vertical axis, quantity on the horizontal axis. The price in this case, though, is interest. That's the price of money. If you rent money from somebody else, which is what borrowing is, you take money that somebody else has, you make use of it now, and then you pay it back, you have to pay a price for that. The interest rate is the price. Borrow $100, pay it back with 1% interest. Then what you're doing is you're taking $100 that doesn't belong to you, you're doing something with it, and then at the end of a specified period, you're giving it back, or over time you're giving it back, but once you give it all back, you get back $101. It's a very simple scenario that doesn't involve amortization, but we don't get into that in this class. So the interest rate is the price. The quantity in a money market is the quantity of loanable funds, typically. The quantity of dollars that lenders are going to lend out to whoever needs a loan or wants a loan. Typically, this would be banks who will lend money to someone looking to buy a home. They'll lend money to a small business owner to start a business, or to a big business to expand, or any business to expand. Anybody who needs more money than they have on hand right now, or at least who finds it to be a better way of leveraging money to borrow it from the bank than to take it out of any other holding that they have at the moment. Whoever needs the bank's money or wants the bank's money, the bank will give it to them, and then they'll pay it back to the bank with interest, and that is essentially how banks make money. At its simplest, the money market graph, though, it doesn't specify banks. It just talks about people who loan out money. People have a lot of money, people who are wealthier. They don't want that money sitting in a vault under a mattress or whatever. They want that money working for them because, as we now know with quite a bit of detail, inflation is going to eat away at the value of that money. You have $100 today, stick it in your wallet and don't touch it for 50 years, it's going to be worth a lot less than $100 at the end of that 50-year period of time. However, if you take it and you put it into some sort of interest-bearing investment, and that interest rate is able to at least keep up with inflation and hopefully exceed inflation over that period of time, that same $100 is going to be worth more than $100 at the end of 50 years. So if you have extra money that you don't need to spend right now, then you want to put it to work for you in a money market, which means you want to give it to someone on the demand side of that market who does need the money now, like someone looking to buy a home. They need the money to buy the house. Good financial investment for a lot of people. We want money markets to work well. It's what caused businesses to get bigger and hire more people and generate more wealth and create more competition that causes prices to go down in a non-deflationary sense. We want people to buy homes, so there's a little more stability as far as people's financial situations, so they can be more robust consumers, and of course their own well-being is better off. We want money markets to work. We want lenders to lend to borrowers, and we want borrowers to be able to access loanable funds from lenders. But there are some problems here. In most markets, this second part points out that the demand side can go straight to the supply side, shop for whatever they're looking for. A price is agreed upon, which usually means the vendor lists a price and the consumer is either going to pay it or they're going to walk away and no transaction will occur. If it does occur, it's a mutually beneficial transaction. If you're on the demand side and you're looking to buy something from the grocery store, you just want to go buy some food. You go to the grocery store, you get food, you pay for it, you go home. It works smoothly. It works great. Everything's nice and simple, and that's the way we want all of our markets to work. But that's not the way all markets work. A lot of markets don't work that smoothly, and some of them don't work very well at all because of these kinds of issues. Because of issues like asymmetrical information, asymmetrical information is basically the problem of not knowing what you're buying. You think you know what you buy, but after you've paid for it, is it really what you thought you were getting? This is certainly a big problem in financial markets, not just for the borrower, but for the lender. In fact, a lot of this is on the slide here. The money markets don't work that smoothly. Suppliers don't know if the borrowers are going to pay the loan back. And we're usually talking about large amounts of money. Someone buys a house that they need $200,000, let's say, to buy the house. That's a lot of money, even if that's a cheap house these days in some markets. That's a lot of money. Think about if you have $200,000 lying around, even if you're really rich, you don't want it lying around depreciating in value because of inflation. You want to put it to work, but when you give it to somebody else, they have that money and they're going to spend it on somebody. On something. That's the whole point. They're going to buy a house or something. How do you know you're going to get it back? The answer is you really don't know until you do get it back. But some people are good for it, and we can tell early on that they are. Others, we're not so sure about. So anyone who has extra money lying around, not necessarily a bank, just a person who has money that they would put in a bank, if they're going to lend it to somebody, how do they know that somebody is a good person to lend to? And if you're going to take out a loan from somebody, how do you know that you're getting the best interest rates? How do you know that you don't have hidden fees or whatever? Unfortunately, we don't, and that sort of thing happens, but it doesn't happen to the extent that it would without a financial system. Hey, how do you know you're borrowing from someone who isn't a loan shark, who's going to send somebody out to break your thumbs like in Rocky? Gazzo says you don't have the money, I should break your thumbs. How do you know you're not dealing with somebody like that? And then, of course, unforeseen risks. What that means is that life happens. If you're lending money to somebody who has a high income and good credit, and someone has good credit, they've worked hard to get that credit score up. They don't want that to turn into a bad credit score, which will happen if they don't pay back money that they borrowed. So they're going to pay it back to keep that credit score pristine, and they have a good high income that helps make sure they can pay it back. What if they lose their job and their income becomes a really low income and they can't afford to pay it back? Even people who are credit worthy can be risks in that regard. So there are a lot of problems that at the end of the day are going to be non-starters. Hey, you look like a good person to lend to, but what if you lose your job? That's $200,000 in the $200,000 example. That's a pretty big risk to take, because all it takes is one person not paying it back and you can lose a ton of money. So all of these are things that if money markets work like any other market, it shouldn't work. It shouldn't work very well at all. So that's where financial institutions come into play. And in the next video, we're going to go into a little more detail about how that works. And since this is an economics class, we're going to go into detail about the jargon we use so we can sound fancier while talking about it.